Hi friends, my name is Rohan Bharath Chandra. In our YouTube channel, we have made many videos about PE ratio. PE ratio is high when the stock price is high and the earnings per share, that is the net profit divided by the number of shares, is quite low. This could mean that the company's performance is not very good, but the market is expecting too much and hence the share price has rallied a lot. Price to earnings ratio is a very simple formula, market price of the share divided by the earnings per share. Usually, the PE ratio of companies which are leaders in their respective sectors are higher than the other companies in the same sector. However, if the business performance of the leader falls, then the PE ratio will fall since the stock price will automatically correct because of the lower performance. Although P ratio should not be the only factor to decide whether a stock should be bought or not for long term, if the P ratio of a stock is too much, then we must be very careful to avoid the stock, or we must be very confident that the business performance will be good to justify the high valuation. Especially if you are doing lump sum investments, then P ratio becomes very important. If you are doing monthly investments, P ratio is not as important as the lump sum investments. In the last 6 weeks, a large number of individual stocks have fallen a lot due to the overall market weakness. So the P ratio of such companies have also fallen. For many companies, the current P ratio is lower than the 5-year average P ratio. Stocks trading at P ratio higher than the 5-year average. Number 1, Eicher Motors, current P ratio 31.3, 5 years average P ratio 36.5. Maruti Suzuki 25.3 current P ratio, 5 years average P ratio 37.1. Bajaj Finance. For financial companies and banks, the appropriate parameter is price to book ratio and not PE ratio. Price to book ratio means price divided by book value of the share, which is considered. Current price to book ratio of Bajaj Finance 4.9, 5 years average 8.5. Apollo Hospitals 90.2 current P ratio, 5 years average 90.8. Cipla 27.9 is the current P ratio, 5 years average P ratio 29.6. Sixth company, once again financial company, HDFC Bank. So the price to book ratio 2.9, 5 years average 3.6. Dr. Reddy's Lab 20.1 is the P ratio and 5 years average 24.3. Asian Paints 56.5 and 5 years P ratio average is 36.4. Titan Company 87.2 is the P ratio currently, 5 years average is 89.3. Many of these companies are very popular among retail investors since they have consumer facing businesses and have also given high returns to shareholders in the long term. Most investors in the market do not know how to research nor want to do the hard work to research. They just blindly buy whatever is going up or whatever is talked about a lot among the brokers or friends. High P ratio does not mean that a stock will not continue to do well. However, the company's business must continue to grow well so that it can maintain a higher valuation in the stock market. So if it's a high P ratio, then the expectation is very high. If there's a lower performance, then the stock may fall more than the other companies. Observe these stocks and see how they perform in the next 6 to 12 months. It will teach you many things about markets and how stocks react to different situations. If you like this video, please click the like button and mention in the comment section, do you hold any of these stocks currently? If yes, type the name in the comment section. Otherwise, type no in the comment section. Thank you for watching this video. Please share this video with all your friends. Bye bye. All the best.